Hello and welcome to this month's Financial Markets Update. Well, February proved to be a difficult month for financial markets. We saw both equity and bond markets sell off over the course of the month, and this was really driven by ongoing inflationary expectations and the move by central banks around the world to look to aggressively increase cash rates in order to, as I said, dampen those inflationary expectations. We saw through the month of February, all major central banks led by the US Federal Reserve, but certainly the ECB, Bank of New Zealand and our own RBA all increased cash rates over the course of the month. And as we sit here today, the RBA only just recently increased cash rates again by 0.25% to 3.6%, so the 10th consecutive interest rate rise that we've seen here domestically. And while the recent comments from the RBA points to a potential pause, and we certainly remain of the view that now is the time for the RBA to probably take its foot off the pedal in the context of pushing rates higher and wait to see the impact of the rate cycle through the economy, we still believe that we've probably got at least another 1 to 2 rate rises in store for the domestic economy. So that will, in our view, see the cash rate peak somewhere north of 4%, 4.1 to around about 4.25% in our view. So there is still some pain to be had on that front as it relates to official cash rates and the impact that they have flowing through into the domestic economy. We just thought we'd share a couple of charts in the context of how we see cash rates impacting the local economy and why we believe that the RBA certainly should take a pause in the context of its program, and most likely is, as we've noted on previous occasions, closer to the end of the rate rising as opposed to the beginning. It's a little bit of a different story in the US, and again, most notably, the recent comments made by the US Federal Reserve do point to the fact that cash rates are likely to push well north of 5%. We still see peak terminal rates in the US around about 5.5%, so still some ways to go on that front, but notwithstanding, as I said, inflationary expectations right across the board remain challenging. They remain well north of central bank targets, and so from the perspective of central banks and certainly from an economic outlook perspective, it's likely that cash rates will need to go higher through the first part of 2023. When we think about the domestic economy, you can see here on the first couple of charts and just noting the post-COVID impact in terms of the savings ratio. And through COVID, as expected, when people couldn't go out and certainly couldn't spend, we saw a significant uptick in the savings rate. But that has completely evaporated over the last 12 to 18 months. You can see the savings rate ratio now back towards 4%. This is actually, when you strip out the period of COVID, below the average over the last 20 years. So, people are clearly dipping into their savings, and it's not surprising as a cash rate has risen that obviously the level of savings has declined. Equally, when we look at the chart on the right-hand side, you can see here that the indebtedness of the Australian consumer is at an all-time high. The debt-to-income ratios you can see there peaking as we've seen over the last couple of months. At the same time, obviously, we've seen cash rates move higher. So the serviceability side of it for the average Australian household has clearly declined as well over the last couple of years. So again, from our perspective, when we think about that in the context of where rate rises are at the moment, we expect that is starting to have a significant impact in terms of the overall strength of the economy, and certainly, as I said, both in terms of consumer behaviour, but also the importance of consumers being able to maintain and cover for their debt profile. And just when we think about the housing market more broadly, you can see again just the data coming through February, just in terms of private home starts. You can see that they also declined sharply over the period, and that clearly reflects the demand profile starting to wane. But the extent of that decline, we believe, was probably the most notable element associated with what we saw over the course of the month. And as I said, expectations were for a positive number, and we saw, as I said, a significantly lower number over the course of the month. So from the backdrop perspective, when you're thinking about both on the consumer as well on the housing side, two significant sectors in the domestic economy, they clearly have been hit relatively significantly over the last 6 to 12 months. And as I said, as we start to see those cash rate rises continue to work through the domestic economy, we think that it's going to have a bigger impact as we move forward from here. And then finally, just looking at the context of the cash rate cycle, and I think this is particularly important just to sort of understand where we've been over the last 12 to 18 months relative to prior hiking by the RBA over the last 20 years or so. And you can see here that when we think about the cash rate cycle, we think about the impact that the cash rate cycle has on the domestic economy, just the speed and nature of the moves that we've seen has been the most significant aspect associated with cash rates and the impact that it's had, both in terms of the consumer behaviour as well as what it can have on the broader economy through time. And you can see, we've had over a 3.5% increase in only 11 months. And when you're comparing that to the last 20 years and the cash rate cycle of trough to peak over the last 20 years, two things really stand out. Clearly, it's the most significant move that we've seen in terms of absolute cash rate rises. And as I said, we don't believe it necessitates that the RBA has stopped. And equally, the speed by which that has occurred, as I said, has been the quickest that we've seen over the last 20 years. So both financial markets as well as obviously consumers haven't had the same length of time to equilibrate and adjust their spending habits, as well as obviously the impact that it has in such a small space of time. We've seen that most notably through mortgage rates, which have obviously peaked and can move significantly higher over the last 12 to 18 months. So the overall impact can be quite significant. As I said, we do believe that the RBA is likely to increase cash rates further by, as I said, our estimates by at least another 0.5%. But we do think it's warranted for the RBA to certainly pause in April and potentially in May as well, just depending upon what the economic data looks like. More broadly, when we think about our positioning across our portfolios, as I said, we haven't made too many changes to our investment positioning. The market at the moment, as I said, is very attuned to economic data, as it should be, but equally also the impact and the wherewithal in terms of where central banks are looking to take the rate cycle program. Notwithstanding that, inflationary pressures continue to remain very sticky, and we're not seeing a material moderation in inflation, both at a headline as well as at a core level, so excluding volatile items, over the last couple of months. And again, this is one of the key reasons why we think that the rate cycle has still some way to play out over the first half and potentially the first 3 quarters of calendar year 2023. So all in all, February was a bit of a pullback month for financial market performance. A lot of the challenges that we saw in financial markets, whether it be in bond or equities, really related to, as I said, the moves by central banks, the stickiness of the inflation print coming through both domestically and globally. We may have seen peak inflation across global economy, but notwithstanding, as I said, not coming down at the rate that central banks would like. So that precipitates further rate rises, continues to make it a little more challenging on the investment front for sure. But from our perspective, as I said, we're getting closer to that peak rate cycle. And should the economy continue to remain in relatively sound shape, highlighted by unemployment, which continues to remain at close to multi-decade lows, we feel that it is possible for the both domestic as well as the global economy to muddle through without a significant recession taking place. That, in our view, would be positive for financial markets and would afford, obviously, increased flexibility in the way that we look to manage our portfolios, particularly the balance between equity and bond investments, because, as I said, the higher yields are going to provide an attractive opportunity for bonds. And as I said, once we see those peak rates coming through, we believe quality businesses on the equity front, both domestically and globally, will be able to move higher from here. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks and bye for now.